On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Mortgage rates have slumped more than 2% over the past 18 months, but don't expect too much more relief from here. This is almost as good as it gets for borrowers. Let me tell you why that is. The Reserve Bank of New Zealand, the RBNZ, left the official cash rate, the OCR, unchanged at 3.25% last week. That was widely expected by economists and financial markets. It was actually the first no-change decision in a whole year after 6 consecutive cuts that took the OCR from a 15-year high of 5.5% to its current level of 3.25%. One reason for the pause last week is that the RBNZ is braced for a spike in inflation. It does, however, believe this will prove temporary because of the spare capacity we're seeing in the economy. At 5.1%, unemployment is the highest it's been since 2016, excluding that very unusual COVID period, and it's expected to push a little bit higher before it stabilises and starts falling again. This level of labour market slack usually keeps a lid on domestic inflation pressures, so the Reserve Bank is likely to look through a quarter or two of prices going a little bit higher than it would like. The bank isn't yet done with cutting interest rates, but a really important insight for borrowers from last week's decision is that we are nearing the end of that easing cycle. Of the big 4 Australian banks and KiwiBank, our own bank, forecasts for where the OCR ultimately troughs range from 2.5% to 3%. I think there's 2 of those 5 banks at 3, one's in the middle at 2.75 and the other 2 are at 2.5%. The most recent Reserve Bank projections from May suggest a floor of either 3% or 2.75%. Their projections are kind of in the middle, and the odds are slightly tilted towards the latter, 2.75%, but it does look close to a 50-50 call. So however you choose to believe, it is clear that the bottom is getting closer. Now, for most of us, this matters because of what it means for borrowing costs, mortgage rates, and the household budget. Mortgage rates have already fallen a long way. The 2-year rate is about 5% right now, down from 7% at the end of 2023, which is about 18 months ago. Now, it's really important to understand that your mortgage rate isn't driven solely by what's happening with the OCR. Global economic conditions, wholesale interest rates, bank funding costs, competition amongst lenders, all of those things can have a big influence too. But there's still a strong relationship between the OCR and mortgage rates, especially for those shorter mortgage terms. Now, in the past 6 months, the gap between the OCR and the 2-year rate, which has traditionally been a favourite of Kiwis, that gap has been about 1.5%, which is well below the average since 2017 of 2.2%. So that tight spread could mean that there's less room for mortgage rates to fall, even if you do see another OCR cut, or 2 more, or 3 more. Now, the outlook could change if we experienced a global economic shock or if inflation did prove to be more persistent than expected. However, right now, the base case points to limited further relief for borrowers. Our biggest lender, ANZ Bank, is likely to have some pretty good insights into the mortgage market. In its latest monthly property report, which you can find on its website under Economics, it suggests that the 2-year mortgage rate will bottom out at 4.9% later this year. That's only marginally below current levels. ANZ's got the 1-year rate slightly lower at 4.7%, while the 3 and 5 year rates don't actually dip below 5% in its projections. Now, this quite conservative outlook for any further declines in mortgage rates is notable, given that ANZ, along with Kiwibank, those are the two banks that see the OCR falling the most to 2.5%. So they've got the most aggressive forecasts for where the OCR goes from here and how much lower it ends up, but they're still quite conservative in terms of where mortgage rates might fall to. The upshot here is that most of the downward move in mortgage rates is behind us, particularly for those medium and longer terms. Now, I wouldn't say this is quite as good as it gets right now for borrowers, but we are much closer to that point than many people might think. The next OCR decision is due in late August, and importantly, this one will see the release of a new forecast set. We'll get a monetary policy statement, which means a new set of economic and financial projections. We'll also get a press conference with the team, so we will learn a lot more about where the Reserve Bank is at in August. This makes it the natural opportunity for the next OCR cut to come, but there are a few things we need to keep a close eye on between now and then. Next week's June quarter inflation report will be important. That's out on Monday at 10:45 a.m, while the unemployment report, the labour force report for the June quarter, which comes out on the 7th of August, will also be crucial. Now, assuming that those two releases are quite close to what the Reserve Bank is expecting and what they had in their May forecast pack, there is a good chance we will see a 0.25% cut to the OCR in August. That would take it to 3%, close to neutral and pretty much where it sat comfortably for the 6 years from 2010 to 2015. The focus would then shift to whether that's as low as it goes this cycle or if there is more to come. However, with mortgage spreads already compressed relative to recent years and the OCR already within neutral territory and pushing further into the middle of that range, borrowers hoping for much lower mortgage rates could be left disappointed. If you are thinking about refixing your mortgage, should you go short, should you go long, how should you stagger it? I think it's a really good time to talk to a professional, get some mortgage advice, and make sure that you make some sensible decisions, because we are reaching that point where rates won't be going too much lower. Hopefully that's useful, team. We'll talk again soon. Thanks for listening.
For more insights, visit craigsip.com.